Let's go into our next segment, which is Wrap the Week. This is where we take a step back on a Friday and try to make sense of how this week fits into the big picture. I did want to start with a survey that we did recently. And as a reminder, we always have a survey running on the StockCharts TV channel on our website. So to the right of the video, you can always answer the open poll, and I'd encourage you to do it. It's a great way to continue a dialogue between you guys, the viewers, and me running the show, and other hosts as well, which will refer to those polls. Also on our YouTube channel, we have polls going as well. So if you subscribe to our YouTube channel, you'll get some poll notifications as well. We asked you, will crude oil trade above $30 again this year? It's so funny. We asked this exact question a couple months ago, and I think I asked it as $60. And so I don't think we could do that anymore just because the world's changed so much. But this is the chart we're referring to. This is the $WTIC. It updates every day for us, and it's the crude oil continuous contract. It's one of the futures that we track on here. And so right now it is around 1650. We'll see on Friday's close where that ends up. But basically, will it trade above $30 a barrel, which would basically put it above the peak from April at this point? The answer was almost split. 56% of you saying yes, you could expect it to go above $30. Only 44% of you said no. So actually a little more even. Last time we had a bit of a distribution. This time it's sort of a 50-50 guess, a little more on the positive side that we'll reclaim that. Again, that seemed ridiculous when we're down here in single digits, but you know, it only, with how the volatile that oil is trading now, it only takes a couple of days for that to seem much more accessible. So, and the reason why I phrase it that way is important. I think you could see crude oil recover for sure. I think there are a lot of people, a lot of firms, a lot of investors that are interested in getting back at least into the range where it was March to April, if not much higher than that. And obviously, a lot of companies are gearing more towards that sort of range in the $50-$60 a barrel range, and we're well below that. But we have to get through that first congestion first. I think when oil does get back to that level, that's going to be really the line in the sand, $30 a barrel, depending on how things roll over. Continuing in our efforts to wrap the week, what I like to do is use the Mindful Investor Live chart list, which is, where did I put that? Here it is. Nope. Give me a second here. I got lost in my own charts. Here we go. So this is looking at the Mindful Investor Live chart list. Again, if you've not accessed this before, this is open to everyone. Just click on the articles page, go to my homepage on StockCharts, which is called the Mindful Investor. You'll see a link to the live chart list on the top. You can get right to this list of charts. But this sort of goes through how I walk through the universe on a weekly basis, and I refer to this during the week often as well. What I'm starting with is the weekly market trend, and this is a chart that I've used for a while now. And it essentially, you know, for me, the market is in 3 time frames. The long term is multiple years. The medium term is a couple months to a couple years. And then the short term is a couple days to a couple weeks. And I really don't pay as much attention below that. It's not where I'm trying to anticipate turns. It's information, but it's less the trend that I'm trying to operate on. So this chart sort of encapsulates what those 3 time frames are looking at right now. So on the top, we have the 21 and 34 week exponential moving averages. And then this is the PPO showing you the difference between those two. And if this is above 0, that long-term trend is positive. If it's below 0, the trend is negative. So it turned negative mid-March, has remained negative again. And that's one of the reasons why it feels like a bear market rally. It feels like the weight of the evidence still lower based on the severity of the sell-off that we had February into March. The bottom, we have a weekly PPO, similar to a weekly MACD using the traditional settings, 12, 26, and 9. And so the lines here, the green and the red lines, are the weekly PPO, and whether or not that's been a sell signal where it crosses down through the signal line or a buy signal where it crosses up, that defines for me the medium-term trend. So this turned negative mid-February before the long-term trend, and has remained in a negative pattern. That short-term time frame for me, I use the difference between those two bars, and that's the histogram here in the middle. So that turned negative beginning of April and has remained positive. I'm sorry, turned positive beginning of April and has remained positive over the last couple weeks. And that's where you sort of measure this bear market rally. And that's why I keep saying bear market rally and over, because that's the chart that I would use to sort of quantify those 3 things. So it remains in that phase. You know, looking at the daily chart of the S&P, again, I think we're sort of in this range now between resistance and support. And these are actually drawn from support levels going back over the last year and a half, really from the 2018 market low, which was down here. We had that rally to the market peak in February, even though a number of sectors peaked out in January. And now we're sort of settled in that range, right? Between 2720 and 2870 or so. And again, I think I'm looking for which way we break out of that range. It's been range bound for the last couple of weeks. The RSI is almost dead even at 50. It's a little above the neutral level, but essentially telling you there's an absence of trend at this point. We had the rally and now we're just chopping around, and it's unclear whether buyers or sellers, I think, are going to take control from here. Now, the breadth picture overall has remained positive, but not, depending on which chart you look at. I think this is one chart that sort of confirms the bull market sentiment in the short term, which is the cumulative advanced decline line. So it's advanced or decliners for the S&P, for the NYSE, for mid caps, and for small caps. And all four of these I've color coded green just because they've shown higher highs and higher lows on that time frame. So as long as that continues, that pattern continues of higher highs and higher lows, I think you have to assume that that this bear market rally is continuing. And the signal that this is reversed is if you get a lower low and or a lower high, some combination of those two, and we haven't seen it yet. So on this, where we're at right now, do we establish some sort of lower high? That would be the next potential signal I'd be looking for. Now, we've seen an absence of new highs and new lows, very few on either side, and that tells you sort of this absence of leadership. There are very few stocks pushing to new 52-week highs. There are some, but very few. It's pretty rare, and most stocks are sort of within this range. And because the range has been so wide, I think these lines are going to remain muted for a little while until you either get a buildup of momentum, you get broader buying across the equity space, which would push more and more stocks to 52-week highs, or again, the bear market rally exhausts and you go lower. But again, I don't see that being a huge change in the near future. This is looking at the percent of stocks above their 50-day or above their 200-day. And we're a bit in uncharted territory. We don't have much of a historical analog, I think, to compare this to. But it is worth noting that about a third of S&P names are back above their 50-day. That's up from 0 just a couple weeks ago. So it shows you the severity of the move. Just a couple more quick charts, and then we do need to take a quick break and continue on with our mailbag segment. One really important chart to pay attention to is the AAII rankings. This is the American Association of Individual Investors. This is their bullish or bearish or neutral rating, and it's worth noting because we've had a huge change. The last couple of weeks, it's become closer and closer to 0 with even bulls and bears, and the number of bulls has remained relatively steady in the upper 30%. That has jumped down significantly this week. So down to 25% bulls, down to 50% bears, which puts it more at the level it was on the initial sell-off in March. So it certainly seems like individual investors, in terms of what they're saying, in terms of how they're voting with their voices, are saying they're turning more bearish here at the expecting an exhaustion in the bear market rally. The question now is, do investors vote with their feet and push prices lower? Last chart, I promise, and then we're going to move on, is the ratio of consumer discretionary versus staples. We've talked about how this has been relatively stable. It's just threatening to break above here. And if you draw a trend line on the peaks from March and April, we've now broken above trend line resistance. This is an equal weighted measure of consumer discretionary versus consumer staples, suggesting to me that we're starting to get more of a push on the offensive side. People are going on the offensive side of consumer, which is actually very different than what we've seen for the last 4 weeks or so.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.